Hello friends, I wish you a very happy year 2022 and I hope the coming year, the new year brings you a lot of trading success, joy, fulfillment, peace and prosperity. Now in this video, I want to talk about whether a pre-budget rally is likely, and if it is likely, what are going to be the indications that you should be watching out for. You see, last week, I advocated that technology stocks, which have a weightage of 17.84% in the Nifty, could possibly lift the markets higher. And the markets really performed as per expectations. 3 weeks ago, I had reminded you that a Santa Claus rally could be possible, which is the norm in the calendar year end. And in the week before last, I told you that you should grab the opportunity to short the markets with both hands because that window of opportunity was going to be extremely small and narrow. This was on December 18th. Now, right now is not a time to be contemplating shorts because the markets are in a very different frame of mind. We are going to go there and examine what exactly is happening with the help of very easy to understand charts and graphs and our in-house statistical studies. Now do note that the market is now dominated by younger, faster, more agile and aggressive traders who've come ever since the COVID-based lockdowns were imposed. So the old saying, you should either be quick or be left behind, applies to the traders nowadays. Let's now jump into what really happened in the market last week so that we can guesstimate what we can expect in the week ahead. The Nifty rallied harder than the Bank Nifty in relative comparison because technology is weighted in the Nifty but is absent in the Bank Nifty. Risk appetite returned as safe haven buying in dollar and gold seemed to subside temporarily. Oil rallied mildly ahead of the 4th of January OPEC Plus meeting. A falling dollar had a beneficial impact on Indian equity markets as along with other emerging markets also because imported inflation is controlled by a falling dollar. Bond yields stagnated and the NSE market capitalization rose 2.8%, which means the upthrust was fairly broad-based. The MWPL chart, the market-wide position limits, which you can see on your screen, fell on a week-on-week basis, which is along expected lines after a derivatives expiry. However, what I have indicated to you earlier and is noteworthy is that the peak made in December was significantly lower than the peak made in November and October. And even the fall after expiry in December has been rather noticeable. This hints of a falling risk appetite. Now, can this be just due to the year-end holidays or is there something more than that meets the eye? The coming 8 to 10 calendar days will tell us. Now, usually a pre-budget build-up of positions is seen as per empirical evidence or past evidence. Now, if that occurs, this year too, that means traders are still keen to expand their footprint in the market. Let's continue to watch this space. Now on your screen is a turnover chart of the indices and the individual stock futures. Do remember these are cumulative figures of January, February and March. They show rising volumes on Thursday, which was a bearish session, and a big fall of volumes on Friday, which was a big bullish upthrust session. Now, part of the reason could be the holiday season. So we need to watch this space as well. But volumes crashing on Friday compared to Thursday, of course, is not really very great. You need to follow it up again. Let's not read too much into it. Like I said, it could be the year-end festive reason there. So let's keep our ears to the ground. The basis chart, which is the futures premium enjoyed by an script over its spot, shows the Nifty and the Bank Nifty enjoying a big rise in futures premia over spot because routinely after expiry, traders are willing to pay a bigger premium because they're getting a full month to trade in that security. Same goes for options. The premium rises in the beginning of the derivative expiry. Now we come to the most reliable bedrock indicator of all the studies that I've been sharing with you every week. I'm talking of our in-house exclusive impetus chart. Now, this is something I assure you won't see anywhere else in the public domain. Now, the impetus chart tells me that the Nifty is relatively better poised to exhibit relative strength compared to the Bank Nifty. Note how the Nifty impetus rose on Friday along with the price. Now, this is an ideal situation if a security is likely to go up. And the Bank Nifty continued to lag. Should the price and impetus rise together, a pre-budget rally may be on the cards. Now, first of all, it has to be across the board, which means Nifty and Bank Nifty both should rise in price along with rising impetus. The impetus chart will be your earliest warning signal, and of course, the rally must be accompanied by higher volumes. So, number one, both Nifty and Bank Nifty should rise. Number two, impetus should rise in both these indices. And number three, price should be accompanied by volumes and open interest. That would be the surest sign of a pre-budget rally beginning, failing which the rally might become lopsided. I will continue to share this chart on my social media accounts whenever necessary. So do connect with me on my social media pages. My contact coordinates come at the fag end of this video. Now let's see what the different categories of traders did last week. We'll start with FIIs. Their index net long futures position went up to 64,448 lots, which was last week 51,381 lots. Their stock futures long positions rose to 2,08,281 lots, which was last week 1,74,413 lots. So the FIIs seem to be optimistic. Now let's see what the DIIs are doing. Their index net shorts have come down to 56,408 lots, which was last week 61,125 lots. Where their individual stock futures shorts are concerned, their shorts have risen to 16,55,889 lots, which was last week 16,43,552 lots. Where proprietary traders are concerned, now these are super sharp traders, brokers own prop trades or individual trades. They are second best to insider trading because these guys know who's buying and how much. So the prop traders have increased their index net short positions to 12,969 lots, which last week was 2,197 lots. Where their individual stock futures positions are concerned, they've come down marginally to 1,78,435 lots, which last week was 1,89,775 lots. Where retail traders are concerned, now do remember that the retail guys have been doing all the heavy lifting where buying is concerned. So the retail traders have seen their index net long positions fall to 4,929 lots, which last week was 12,605 lots. Where the individual stock futures net long positions are concerned, their stock futures are now at 12,69,173 lots, which last week was 12,73,123 lots. So friends, what's really coming to the fore is that prop and retail traders are a little cautious. They're not as gung-ho. They're reducing their net long positions. FIIs are increasing their net long positions. DIIs are mildly reducing their net short position. So clearly, It's retail individual traders versus institutional traders. Who will win? The following 8 to 10 days will tell us. So, the other aspect is whether the retail and prop are reducing their exposure because of holidays or whether they are going to play a safe hand. That also the coming 5 to 7 trading sessions will tell us. Let's stay connected so that we can basically update each other across social media. Let's now go to the bond yields, and the bond market was quiet because of the holidays. Banks were absent. The only noticeable data point to emanate or originate from the RBI was the press statement that financial markets were somewhat disconnected from economic fundamentals. What I would watch in the days ahead is the bond yields, and of course the economic data released from official sources shows that foreign debt went up to US dollar 593.10 billion, which in the previous period was 571.3 billion. Fiscal deficit went up to 6,956.14 billion, which was earlier 5,470.26 billion. The Q2 current account shows a net negative figure of 9.6 billion, which was in the previous period 6.6 billion positive. The Q2 trade balance was a negative of 44.40 billion, which in the previous commensurate period was a negative of 41.70 billion. Infrastructure output fell in November to 3.1%, and in the previous commensurate period was 8.4%. The data is appearing weak, but it was expected to weaken, especially after Omicron comes in. It might weaken even further. How the markets will react to these data points, which were released post-market on Friday, we will know in the coming 2 to 3 trading sessions. Therefore, watch the bond yields extremely carefully because this is where it will reflect first. Friends, I now go to the US dollar index, which fell 0.42% on a week-on-week basis. It fell on 2 out of 5 trading sessions, but the falls were rather large, as you can see from the size of the red bearish candles. Now, the price is below its 25-day exponential moving average, which is approximately 1 month long holding on cost of an average bull. That means the short-term outlook is weak for now. A weak dollar is actually positive for emerging markets, including India, because it controls our imported inflation. Now, turning to the weekly chart, we see a second consecutive week of declines. The price tested its lowest after 18th of November 2021. Now, so far, the price stays above its 25-week exponential moving average, which means the medium-term outlook remains positive for now. Now, this indicates approximately 6 months holding on cost of bulls, the 25-week exponential moving average, that is. And therefore, the bulls are still in the money. Last week, I advocated a range between 97 on the upside and 95.05 on the downside, which held perfectly well in spite of all that volatility. And the coming week is likely to see an estimated range between 96.60 to 94.65. I suggest you stay sharp because the dollar index will impact everything from our bond yields to base metals, energy, and bullion prices. Friends, let's now go to the Nifty 50, which gained 1.79% on a week-on-week basis. It rose on 4 out of 5 trading sessions, and it closed the gap which it had left on the downside. The index managed to rise to a fortnight high, but do remember the impetus chart was not convincing of the Bank Nifty. Bulls need to push harder to get this index out of its falling groove. The price remains below its 25-day exponential moving average, which is approximately a month-long holding on cost. And as long as the level is not overcome sustainably on the overhang of overhead supply will remain. Overhead supply is when people who have bought at higher levels wait in spite of the price falling, and when the prices come back higher, they are in a hurry to exit from their losing positions. Let's now go to the weekly chart, which shows a large bullish green candle where the body has engulfed the previous red one or the bearish candle. But the price remains below its 25-week exponential moving average, which indicates a 6-month holding on cost of the bulls. The medium-term outlook still remains under pressure till the price is below 36,500 mark. Note on the downside how 34,000, which is a round number, has proved to be a support and has held as a support since 6 months. That's the Maginot line that the bulls will have to defend in case of declines, the 34,000 level. In the week before last, this index was number 2 on the most volatile counters list, but it fell 4 notches to number 6 because individual stock-specific volatility rose much faster than the Bank Nifty. Last week, I recommended a range between 36,475 on the upside and 33,200 on the downside, which held perfectly well. The coming week is likely to see a range between 37,075 on the upside and 33,875 on the downside. Friends, I would advise you to continue to trade light till the impetus chart climbs along with the price. Any pre-budget rally must see the Bank Nifty rising in tandem with the Nifty 50, or the rally faces the prospects of weakening momentum. Friends, let's now go to the Nifty 50, the most liquid, the lowest impact cost trading instrument on the NSE derivative segment. This index gained 2.06%. It rose on 3 out of 5 trading sessions, and the bullish candles were noticeably bigger than the bearish ones. The price has broken out above its 25-day exponential moving average, which is a month-long holding on cost, which means that the short-term traders are now returning back into profits. Note the price is appearing to break out above a bearish channel, which is 2 parallel trend lines, which could prove to be a flag formation with measuring implications for technically savvy traders. Now, the precondition of a flag forming and confirming is the price overcoming a previous swing high, which must be fulfilled before we can say that it has already happened. In our case, it happens to be the 17,640 level, which was a previous swing high made on 13th of December 2021. Do remember that our impetus chart as of now very clearly shows that the Nifty 50 is favorable over and above the Bank Nifty, which means any upthrust is likely to be powered by the Nifty rather than the Bank Nifty. Let's now go to the weekly chart, which shows on your screen a bullish candle for the second week in a row. Only last week the candle size has become bigger. Remember, I had advised you that technology stocks with a weightage of 17.84% were likely to boost the Nifty over the Bank Nifty. The price is back above its 25-week exponential moving average, which indicates a 6-month holding on cost of a bull. The medium-term outlook has improved somewhat. Let's wait and see if the 17,640 level is overcome with sustainable close above this threshold. On the flip side, if the index slides below its 25-week exponential moving average, that could put bulls in a spot. In the week before last, this index was at number 9 on the most volatile counters list. It climbed 2 notches to number 7, which is because the index made big gains on the last day, which is Friday, along with impetus rising. Last week, I advocated an estimated range between 17,550 and 16,400, which again held beautifully in spite of the rising volatility. The coming week should see an estimated range between 17,925 on the upside and 16,750 on the downside. Friends, I would suggest you continue to trade light and maintain your stop losses diligently. Await confirmation of a rising impetus along with the price before buying aggressively afresh. Friends, the indices done. I now come to the most popular segment of my video where I give you 5 stocks which are high impetus, high volatility, where you take small exposure, wait for large price moves, and 5 stocks which are low impetus, low volatility, where you take big exposure, wait for small price moves. Why the difference? Because different traders, different mindsets, different attitudes, and therefore different strategies. On your screen now, the high impetus, high volatility list is led by Ipca Laboratories at number 1, Dr. Lal's Path Lab at number 2, Alchem at number 3, Asian Paints at number 4, and Titan Industries at number 5. Low beta, low impetus stocks list is led by India Bull Housing Finance at number 1, Bank of Baroda at number 2, Federal Bank at number 3, HDFC Limited at number 4, and Axis Bank at number 5. If you've noticed something, all the low beta, low impetus stocks are from the financial space, banking and financial space. That tells you that something's cooking there. Now, friends, this hierarchy of high and low beta stocks can change from hour to hour, day to day, and it would be helpful to you if you connected with me on social media where I update this data every day post-market. Before I sign off, my friends, in the description below this video is a hyperlink to my playlist on Equity Masters YouTube channel. Please do subscribe to my playlist there. I put up a couple of ideas there every week as well. And there is a hyperlink to availing a free trading guide from Equity Master in PDF format in a separate list. In a separate hyperlink. Do avail of this fantastic opportunity as well. Friends, I bid goodbye to you, and not before reminding you to click like on this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. Good, bad, or ugly, please let me know what you think about this video in the comment section, and help me reach out to fellow like-minded investors and traders by sharing my video with your family and friends. Thank you for your patience, my friends. I wish you have a very, very profitable week ahead till we meet again in my next video. This is Vijay Bhambwani signing off for now. Take care. Bye-bye.